got a strong bullish deal book, giving us a lot of confidence that this gold price is going to break higher. When we see the smart money and the deal book both bullish like this, we know that we're not going to get the bottom edge. At least we should not be able to get the bottom edge. If we're getting the bottom edge, we'd love it, but it's unlikely. So what we've got to be aware of is any type of a jam and jump. As soon as we see the price jamming at 40, we jump at 40. We traded 50, we made $1,000. We were only in the trade for 10 minutes, which was kind of good. So remember, smart money isn't about whether we're buy or sell. Smart money is about what the dealers are currently doing, whether we agree with it or not. If the smart money is going up, the dealers are accumulating long positions. If the smart money is going down, the dealers are accumulating long positions. But we can only use the word accumulating when we see the value or the deal book and the deal book being bullish. If the value was bullish and we saw the smart money going up, we would now agree that the dealers are accumulating into this price area. So this is what we start recognizing as the norm from our operations. We don't look at it from the point of view of simply whether the line is going up or down. That is not the signal. It's like delta. Delta being bullish or delta being bearish is not a signal. You saw, for example, here on this sell on the S&P that we then took on the retest. This is the one that Melvin joined me with as well, that we took a short sell in this area here. You can see at this stage here, the smart money is sell side and the deal book is sell side. So we want to get aggressive on this. We want to be willing to play as the price. Now, this tells me that this is a short accumulation. So without using the deal book, why would we understand the concept of short accumulation? What does it mean and how do we see it? Well, pretty simple. If we see prices moving down into an area, there are one of two things that can happen, right? So we see prices moving down into an area, so it's two exactly the same charts approximately. And one of two things can happen. So the first thing we know about is, of course, we know that value is bullish or bearish. So let's assume that on both examples here, value is now bullish. Well, we don't dictate whether the buyers are coming in or the sellers are coming in. That's not up to us to determine this. So one of the things that we have to understand is that we don't know which one it is, and we don't actually really care much which one it is. So if we had the smart money line, now remember the smart money line is the opposite in some respects to the market delta. It's not negatively correlated to delta, but it's reflecting the impact that delta's having. So that's what we're going to draw in the charts is the smart money line. And one of the smart money lines might look like this, and the other smart money line might look like this. So what's the difference? The difference is on the execution. So if we look at this here, if the smart money line is falling, what does that tell me about the smart money? There is a lot of buyers in this, right? There's a lot of buyers on this trade, right? So in other words, if the smart money line is falling and the value is going up like this, then we know that there are a lot of buyers. There's a lot of delta buyers coming into this. That's why the smart money is falling, right? So there's a lot of delta buyers. Well, if we know there's a lot of delta buyers, we also know that this leads us to a execution trade idea. If there's a lot of delta buyers, the one thing we don't do is we don't pay retail prices for these entries, assuming we want to buy with the value, of course. So because there's a lot of delta buyers, we know that the entry that we're going to use to buy into this has to be very passive. So we put our buy entries into these passive areas down here, right? We start looking at passive buy entries. Because at the moment, that's what the dealers are doing, right? That's what the dealers are doing. So we are passive buyers. In other words, if the smart money line is dropping, you drop the bid. It's not that difficult to figure out, right? If the smart money line is dropping, you drop the bid. If the smart money line, however, is rising, you start getting ready to be active. In other words, you start getting ready to buy after a rejection of something. Does that make sense? So when we understand that the smart money line is now rising, what does that mean? That means there's a lot of delta sellers coming in, right? So we want to do what? There's a lot of delta sellers come in, and if there's a lot of delta sellers coming in, we want to use that to trap. So in other words, the trade entry is a trap entry. So we're trying to trap those delta sellers, and we should see it because those delta sellers should provide us with what? What should we see on our screens? What should we see on our screens? We should see Voltics, for example, big sell-side leans because there's delta sellers coming in. So we should see Voltics or sell-side leans, shouldn't we? And then as we see those, we buy above those trade execution areas there, right? So you'll see the difference. This one is a very, very simple fade, passive buy trade, and this is a lot more active. And what we shout this one out as passive buying. This is a passive bid, and this is the dealers. If the deal book is then added to this and the deal book is going up, then what I'm going to shout out at that stage is I'm going to shout out that the dealers are accumulating longs, right? So this gives us an idea that if this was at higher prices, the dealers would then be accumulating longs, and we would get a very strong rush into this trade. We would be seeing this as a very strong buy signal. Well, that's exactly what's been happening in gold on the last couple of swings, hasn't it? If we look at the last couple of swings on gold there, you'll get a very, very good feeling about what you would have been looking for based on this narrative building process. So let's just take a goose at gold, and we'll see what gold provided us with in terms of narrative building tools. So this is gold. One of the things you'll be able to recognize just into the bottom edge here 20 minutes ago is that the deal book goes bid. So we're using the deal book instead of value, but it doesn't matter. It is what it is. And at the same time as the deal book goes bid, the smart money goes bid. So if you're going to draw this is why the smart money line, a lot of people get confused about what we should do. It should not have any confusion about what we should do. It should be really quite simple. If the red is above the yellow and the yellow is rising, then your entry for a long position when the dealer goes buy side should be aggressive. You understand that? It should be aggressive. And buying into that aggressive play allows you a very easy ride out of town here. Now, on the other side, you can see here, for example, in this red candle here, the deal book actually went sell side, but the red is above the yellow, and the yellow is rising. So if I wanted to sell this, could I sell it? No, because we haven't seen any sell levels yet. We haven't seen the sell. So if I want to sell this, it has to be on that type of angle. In other words, you just draw your offers in the shape and direction of the yellow pink line narrative. You understand that? So if I want to sell at any stage here, it's always got to be on an uptick. It's always got to be on a green candle. It's always got to be into maybe a spring trade. So with this dropping down here, I could look at this trade here and say, well, we're getting a nice pop back above here. I might sell into that. I might take a shot at that, but I'm going to have to get that. I'm not going to sell here, right? That's not the right trade in that location, is it? So if I'm going to be taking another shot at it, sure, I might take a shot at that, but I'm not going to sell here. That would be in the wrong location, wouldn't it? So the smart money line allows us to make that decision. It teaches us to make sure we know where to deal. So we can tie in the storylines regardless of what the value or the deal book or anything else is doing. We know what the execution should be. Follow the red line, follow the yellow line. You've just got the red line, follow the red line, the smart money line, and just make sure you don't execute in the wrong place. It doesn't mean the market's bullish. It doesn't mean the market's bearish, just like Delta doesn't mean the market's bullish or bearish. it shows you how to execute if you want bullish or bearish trades at any price. So when this is a buy trade here, the deal book's bullish, I am a buyer aggressively. So anytime I see a buyer, I am going to try and take part in this. When this is dropping, but the deal book is still, the smart money is still bullish, then I am a seller, but at a higher price. I demand higher prices. I demand green candles. I demand an extra bit of buck for my money, a little bit more buying, a little bit more sizzle into the top edges. I don't want to pay retail if this is going up like this. If this is going up like this, if I sell at these bottom edges, I am going to get mauled. I've just paid retail. And that is going to be a real problem if you start doing stupid stuff like that. So just don't do the stupid stuff. Make sure you get the good stuff. Make sense? So a lot of people think the smart money line is a lot more complicated than it is. It's not. It's a really simple line, guys.